Yes, another reason why we believe the S&P 500 will fall, backed with strong reasons. Check them out. Yes, we continue to discuss how overvalued the S&P 500 is, and we believe it will take a big hit. I wish we could give you the exact date, but unfortunately, no one knows when that will happen. Eventually, equities will go on sale, and I believe as an investor, you should be prepared to do some shopping when that time comes. U.S. stocks and the S&P 500 have done extremely well over the past 15 years, far above almost anything else. Now, looking back in history, there's only been 4 times this overperformance has happened. The Roaring '20s, the Nifty 50 during the '70s, the internet bubble, and today's market. If you look at how the S&P 500 has grown, a big portion has come from multiple expansion, which means valuations have gone up. The United States now accounts for 60% of the world market, and it's 10 times bigger than the next country. When looking at the CAPE ratio, which I've talked about before, it is currently at 38. It is more than 3 times what it was in 2009 when it stood at 36. I believe to protect against the downside, you should be looking at investing in equities that are not overpriced. Let me give you 4 big factors as a baseline we recommend you look at. First, we like companies that pay dividends. They should be sure to verify that the payout ratio is not above 70 to maybe 75%. This could put the dividend at risk if they're using too much of their earnings to pay out that dividend. Cash flow also is another important factor. Be sure to verify the company has good positive cash flow from operations. We like businesses that have enough cash flow where they can buy back their own stock, which benefits their shareholders. I think it's also important to verify the company is not using debt to buy back their stock. Speaking of debt, be sure that the company is not overburdened by a large amount of debt and that most of the debt is long-term. Heavy amounts of short-term debt could leave the business at the whims of short-term interest rates, and now with a higher interest rate environment, refinancing that debt could have a negative impact on earnings. The 4th factor is valuation. Businesses can do all the right things, but if their stock is too expensive, well, that could hurt the stock price down the road. There are many other factors to look at, but these are 4 big ones that can maybe, just maybe, keep you out of hot water. I'm Brent Wilsey with Wilsey Asset Management. Stay ahead in the investment world by subscribing to our YouTube channel and our weekly newsletter for the latest economic news, expert analysis, and market insights.